ట్రై చేసుకో, వచ్చింది అంటే ఓకే, వెయిట్ చేయండి ఒకసారి, రావాలి కదా. Okay, right. So basically, financial management is divided into three topics, that is financial decisions, dividend decisions, and investment decisions. Financial decisions are about cost which is associated with raising capital, and one of the cost is also profit paid to the shareholders, and the one of the prominent way of making a payment to the shareholder is by dividends. Correct? So now when you are making a payment by way of dividend, so dividend is a discretionary power of a company whether to pay it or not, and that, because that is a discretionary, you can make decisions. If suppose it was non-discretionary like interest payment, then you will not have any option to do it. In that way, dividend decisions are pretty much valid topic under financial management. The last one, the most important one, and the one which will tingle you every time is investment decision, because it is a wide area where you can actually practice. Obviously, we have very limited ways to discuss this. So, what is investment decision? Deploying capital. It is how deploying capital, and once we deploy capital, we expect return. So this is a definition which is given where not by Pavan Goyal, it is by ICAI, right? So financial management is by financial decision, dividend decision, investment decisions, right? One of a prominent way, or what they have discussed in your curriculum, the kind of investment decisions are long term. They call it long term. They call it capital budgeting. What they call capital budgeting. Yes, and in the short term, please tell me. Very good. It is called working capital. Done, right? Now let us come to our category. So first category, that was theory concepts, scope and objectives of financial management, types of financing. Types of financing is how do you raise money? That's it. So there are different ways of raising capital, which we'll get into detail whenever it is necessary. Tools based on financial management. This is the important topic, where financial analysis and planning, that is ratio analysis. And then tools not based. See, I have very carefully analyzed the topic and given you, so that at least you should appreciate for me. I've told you what is based on financial management. So ratio analysis is based on, but leverages are not based on financial management. Not based. The underlining word is not. So that means how do you calculate leverages? Not with financial statements at least. Not with financial statement at least. So you have to first learn something else. Then only we can do this chapter. But whatever I am going to teach you, that is the most prominent one for whole of your life, because that will give you an holistic way how the finance has to be looked upon, right? Before we get to that part, let us see cost. Calculation of cost associated with the money, that is financial decisions. Again, that is the second category. So this is the second category. So in this second category, you have topics been divided into again two segments. One is breaking down the cost of the business into the individual cost per source. Raising money through owners share capital, that is one source. Raising money through bank loan is one source. So what is the cost of each source? What is the cost of each source? We are going to learn in chapter 4, that is cost of capital. Second one, how do you compare the different cost and make a mix? Is it required? Is a mix required? Obviously, I am just giving a small brief which will not tingle you much. Do you think a business should have only owner's capital, not outsiders capital? Do you say yes? Now, second question. Do you believe that business should have only debt capital? So that means you come to a common point where you say there should be a mix of both. What is the right mix for your business? What is the right mix for your business? You are going to learn in the second part, that is financial decisions, capital, structure. Structure itself, you will capital ka structure. So you are going to structure your capital, say this percentage of this capital, this percentage of this capital, this percentage of this capital, right? Just to give you a brief, we are going to discuss only three forms of capital. Equity. You know what is equity? Everybody knows what is equity. Preference and debt. So debt would have bank finance, debentures, everything. So it is equity, preference and debt. Are we all good? Done. Next one, sir. The third category, maximizing the returns by making long-term, short-term investment decisions. Right? So this is the highest weight. Right? You have the highest weight for this topic. So first and that above two categories comes in first module. The second last category comes in second module, and the last category, the return itself, is almost 50% of your overall weightage. So that is again been divided into two parts: money management, money distribution. Correct? So money management includes investment decisions, risk analysis of investment decisions, and working capital management. Are we all good? You know, investment decision, risk analysis of investment decision, capital budgeting put together is capital budgeting. A small example so that you relate. You have an option to buy a machinery which requires two labor, right, vis-a-vis a machinery which require a one labor. That is a semi-automatic machine, right? Your mom would also have an option when she goes to buy a washing machine. You will have a washing machine with dryer and washer separate compartments, and you also get washing machine with one single compartment which is capable of doing washing, drying, rinsing, everything, right? So it is one compartment is better than two. They call them as a automatic and semi-automatic. So now which machine your mom would be inclined to take? But it is costlier than the. So same decisions you might have to do in business. There might be so many different kind of questions will put in front of you, situation will put in front of you, wherein you would be supposed to decide what do you do. Okay? So based on that, this chapter 7 and chapter 8, this two would be taking care of those decisions. Those are obviously long term decisions, because once you buy a machinery, or once you buy a machine, or once you do investment in business, it is obviously going to be for more than 1 year, right? Now if it is less than 1 year, then it is a working capital management. How that working capital management will work, that also we'll see. The last one is a dividend distribution, that is money distribution. इतना सब कर लिया सर, पैसे खर्च भी कर लिए, पैसे कमा भी लिए, तो बचे हुए पैसे घर को लेके जाएंगे. So that is called money distribution. Yes. So basically ICI has divided the FM curriculum into two modules. Module 1 focus on financial decision, that is cost aspect of the money. Module 2, that is focus on investment decision, that is return aspect of the money. Are we all good? Sure. I have certain assumptions as a teacher. I have clearly written it. I have certain assumptions as a teacher and have structured the learning for the subject in a manner which is best suited for the students and the people from non-commerce background. So that means, being this is a basic level, I just try to take it from as small as basic as possible. Take it done. Okay. Now we would be starting with our first topic of financial management, and first topic which I want to take up is items which are not based on financial statement. Because financial statement, if it is based on financial statement, easy for you, that will see how easy it is. But before I get on to that part, at least I have to teach you what is not a financial statement. So there is a chapter which is called leverages. Yes, right? Anybody, what is the first thing which comes to your mind whenever you hear this word leverages? Advantage. Yes, one student says advantage. What is the first thing which strikes your mind? Every time, whenever you see or hear something, something what comes to your mind, no, something will come. You will try to frame what it is. That is human instinct. That is a human instinct. If you are a human, as soon as you hear something, you see something, you smell something, you will try to identify what it is. Suppose I blindfold you and I put rajma chawal in front of you, so you try to understand with the smell, right? So that is what I am trying to ask you. What is the first thing which comes to your mind as soon as you hear this word leverage? Earning more with lesser profit. Okay. Earning more with lesser profit. Achha, less efforts. Okay. So you have actually copied the same line from my earlier discussion. Yeah. Okay. For the advantage of all the students who are attending in live streaming also, what all they are giving the reply, I'm repeating it so that it comes in recording. Okay. So financial decision leverages, that is been basically divided into four parts: operating leverage, financial leverage, combined leverage, and income statement. Right? All this is okay. Let us first basically go on to the income statement or income analysis. Right? Let us have a small discussion here. So what does he say? Leverage is, as I asked you, now your term is over. Now I will tell you what leverage is. The term leverage in general refers to a relationship. Please underline that word. Which word? Relationship between two interrelated variables. That means what? That means what? I am going to find out a relationship between two items, two numbers, basically two numbers. But those numbers are not aliens. One from balance sheet, one from P&L, aisa nahi. Those two numbers are related to each other in some form. Right? So that's why it is interrelated variables. Done? In financial analysis, it represents the influence of one financial variable over some other related financial variable. Are we all good? Are we all good? Yes. They have given certain examples. So that is EBIT, EAT, that is earning before interest and tax, earning after tax. All this you need not worry now. We'll discuss it in detail. So there are commonly three leverages: operating, financial, combined. That's okay. So now here he says, in simple, the leverage indicate involvement of risk. Please underline. Very, very important. What does it indicate? Involvement of. So that means now you are entering into a riskier zone. Okay? Yes. How many of you play video games? You play video games. GTA. Oh, PUBG, I should say. So there are some zones now in PUBG. Yes. So this means this is more riskier zone for you to enter. So enter with caution. That means enter with your all senses open. Okay. When I say all senses open, if suppose your body present, mind absent case, I will not be at loss. I've already cleared my exam. Nobody in this planet earth can take back my degree. So that is the advantage of education. Once you have it, you will have it for life. But that is not the case with money. Okay? Even if you have it today, you might not have it tomorrow. So that's why I'm saying you join me in this journey with complete senses open, right? Involvement of risk in the business due to fixed cost. What it is? Due to what? Cost. So what is the risk involved? Risk is fixed cost. I will not go further. I will just want you to imagine this classroom. You need not imagine, you can see it with your naked eyes. Do you see any fixed cost involved? Right? Let us please tell me, what are the fixed costs which is involved here? You tell me, I'm just going to be your stenographer. Please tell me. Huh? Okay, you say rent is a fixed cost. Okay. Depreciation is a fixed cost. Okay. She says equipments. I would say, ठीक है. Depreciation is a cost of equipment. If you would have bought that equipment on loan, then you might also have to pay interest. Right? As of now, I'm not taking that here. Look, no, so many assets. Why nobody is talking about me? Am I also a cost? I am the bigger cost, Baba. Bigger than rent, bigger than depreciation. Yes. Yes or no? Sir, you are my return, sir. You are not cost. Why you are saying yourself cost? I love you, but still, for this example, I consider myself as a cost. Right? Faculty cost. Right? Tell me, is there a difference between a faculty cost and rent or depreciation? Just try. That's why all senses open. Is there a difference between, in terms of nature, in terms of category, in terms of qualification? Use all your accounting knowledge. 11th 12th to pass हुए ना, ठीक है? So use all your accounting knowledge. Tell me, is there a difference between faculty cost in some manner as compared to rent or depreciation? Okay. Okay. So he says, sir, you can go to any other institute. You are open to do, but how rent will go? So suppose there is an institution wherein we are conducting these classes. Now what would happen? Institution has to bear all the cost. Without bearing all the cost, is this class possible? Not possible. Okay. So now what is happening, my dear? Rent is a cost they have to incur. Depreciation is a cost they have to incur. They have to also incur faculty cost. But as you rightly said, faculty has a choice to teach here, any other place or XYZ place or anywhere they want it, right? Yes. But institution doesn't have a choice with some cost like rent. So once they commit, they commit. Correct na? Yes. Nobody will give them, are only if you get students you pay rent, otherwise you don't pay rent. It will not come in that condition, right? Once they commit, commit. Once they purchase an equipment, depreciation is a cost. It will work for what? 2 years, 3 years? Depreciate close. Yes or no? Are we all good? So in that particular manner, can I call? I am again asking you, taking your permission, because I don't know whether you know this concept or not until unless you have attended costing classes, paper 3 CMA classes, right? Now, very important question again. Further, I am just saying. I don't know whether you understand the word fixed or variable, but just for your understanding, I'm saying fixed is something which you don't have an option, which you cannot avoid. As an institution, it is this is, sir. We cannot avoid you, sir. I understand your sentiments, but finance doesn't work on sentiments. There's a first line which you should write down here is no emotions with money, right? So that's why fixed unavoidable, variable avoidable. Is this separation is done in accounting when you prepare financial statement? Is this distinction done there? Yes or no? This is not an answer. Yes or no? No? Sure? In financial statements, have you write finance variable cost, finance cost? No? Right? Okay. So that means this is not, that's why. So am I right in saying that it is not based on financial statements? So that means I did my classification correct. I did my classification correct. So it is not based or not defined. I'm using a short term FS, financial statements. So FS, please write it down. You might make a glossary for you, abbreviations sheet for you, because there are so many which is going to come up. So I would recommend if you have your fixed notebook of any company like Classmate or something. So last few pages you dedicate for this glossaries, references, everything. Okay. Done. So you have financial statements. Are we all good here? Right? Are we all good here? So now what they say is the same thing they say. Sir, even in this fixed cost, they further say, I will not write down because it is already written here, that this fixed cost can be further divided into fixed operating, fixed finance. What is fixed operating? As you said, madam, equipment. One we have not discussed, na equipment we have not written here, right? So please see, this equipment is what? Fixed only. Once you purchase, it is on your name, right? Suppose for an example, you took a loan. You purchase a camera, PS6 camera or some XYZ cameras, you purchase 2 lakhs. Some systems you purchase for 3 lakhs. Total 5 lakh rupees you have purchased. How do you get money? Capital. How do you get capital? Either your money or bank's money. So suppose you took bank's money. So bank money will come with a fixed cost. What is that fixed cost? Interest, right? So is it a cost? First thing, is it a cost? If you say yes, is it fixed variable? Think. Is it fixed variable? So there is a cost associated with it that is called interest. Yes. Now interest, do you have an option saying by, Arey, my institution is not working, faculty is not teaching fine at all, students are complaining and they have gone. So now I don't have your money, I have already purchased with that 5 lakh rupees equipments and camera, take your camera, take your this thing, close my loan. Possible? Possible? How? Would bankers accept a camera and computer in return for their money? So that means you have to pay interest. Yes, that means you have to pay interest. So again, this interest is also fixed. Now here, that interest will come in finance or operating. Why? Keep your all senses open. Actually, I'm investing so much of time so that we don't get a doubt at a later stage. When we go into advanced concepts, then we should not have doubt. Done, guys? Tell me why. Please louder, na? Right? So he says, because I took a loan for an equipment, right? Loan is form of a capital. Capital is associated with the cost. So capital helps me to get money for my business. So it is a finance management activity. Understand? Cost associated with the capital is nothing but cost associated with finance is nothing but the cost associated with the money which I have deployed in the business. Right? Am I able to make this point clear? So what is happening over here is cost associated with the capital always. What do I say here? Cost associated with capital will always be, please, finance cost. Please make it a permanent point. It will be always what? Finance cost. Yes or no? Yes, very, very important. Now, again, most important part. So, how do you distinguish cost? What do you mean by distinguish? Separate them based on the application. Based on the application, right? Yes. Now, if a cost is associated with the capital, it is a finance cost. If a cost is associated otherwise, very good. Otherwise will be for what? Business will have only two costs. One for the business, one for running the business. Correct? Yes. Cost which is for the business is finance cost. Because I have to run the business, I have to have. And for running the business or actually managing the business, then it will be operating cost. So rent, depreciation, right? Everything would be a operating cost. Are we all good here? Are we all good here? Sure. Yes. So fixed operating cost, fixed this one. So now they say, can you manage, again very important, now we are going to the second part of your subject name, manage. Can you manage interest cost? Can you manage operating cost? Yes, no. Obviously you can manage. Obviously you will have ways and means wherein you can reduce your cost. Either it could be interest or either it could be this thing. As you have an ways and means to increase your return, you have ways and means to reduce your cost also. Yes. You can scout for better banks, better interest rate, better everything. Yes or no? Correct. So that's why he says, that's why the chapter name is leverage. Leverage will not help you out in finding out how to manage cost, but it will help you out in measuring the leverage, or you can say measuring where your major cost components are being there. Before you manage anything, you should know what you are supposed to be what you are supposed to manage, right? In order to know what you are supposed to manage, you should know where I am bleeding out, right? Bleeding out is where my most of the money is being spent. So how would you identify your most of the money is spent? With the help of leverage. That's why leverages are not based on financial statements, because financial statement is not a true picture as per financial managers of the overall understanding of the business. Are we all good? Financial statements might be prepared as per Schedule 3, right? Having certain compliance requirements. They have certain reporting requirements, disclosure requirements, whatnot. But financial management has only one objective. We are not supposed to satisfy government. We are not supposed to satisfy XYZ. Only what we are supposed to satisfy is my return should be greater than cost. Yes or no? And larger the difference, better. Larger the difference. So that is what we are. And in order to do the management, there are 3 steps: identify, act, reassess. Identify, Act, reassess. First, identify where is the problem, act on the problem, implement a solution, and then reassess how the solution is working or not. Right? There are so many discussions which I tell you out of my own interest. So, in your interest, if you want to write, you can write it down. Right? So, rent depreciation is your operating expense. I believe you saw it from the book and told. Oh, sir. Okay. Then a fixed finance cost, that is interest and preference dividend, that is analysis of financial. So when you discuss about operating, it is about operating leverage, and you discuss about finance, it is about financial leverage. So 50% of the chapter is over. It was four contents, right? Operating leverage, finance leverage, combined leverage, and income statement. So now you know what is the operating leverage. Identifying operating expenses, right, and finding out the risk involved in the operating expense. And you know now what is an operating expense which is required in order to run the business. Right? Now what is financial leverage? Financial leverage is nothing but the cost associated in order to raise capital, and the cost associated in order to form the business or give start the business. Right? So then we will be able to identify how much is the cost involved, how much is the leverage. So that is financial leverage. Done. There are only two costs, fixed variable. Ho gaya. Can somebody with their common sense tell me then how could a third leverage would be there when there are only two costs? Cost means risk. That's why they said risk involved. Right? So when there are only two costs, two leverages, matter closed. Why there is a third leverage? Sorry, combined. How this third leverage will come? The name is combined. That's why use common sense. Tell me how this third leverage will come. Okay, if we cannot separate operating and finance, then combined. Okay, true. Semi variable. Oh, baapre. You reminded me of my school days. Huh? Not even school days. Semi variable. Oh, after a pretty long time, I'm hearing this word semi variable. But ठीक है. Sorry, that is not semi variable cost. But yes, very good analysis. Claps for you. Okay. Now, yes, going forward. Any other thing? What would be the combined number? On which cost is this associated? So basically, it is total of operating and finance. So multiply. To do what? Multiply. Operating leverage into finance leverage is equal to combined leverage. Simple. Yes. Sir, 75% of the chapter is done. Only one part is left out, that is income statement. What is the chapter content? First page we have given content now. Operating, finance, combined, income statement. Right? That once we start mathematically, you will find it. Why it is into, not addition? Valid question. We'll start mathematics, then find it out. Right? Okay, sir. I'm coming to this chart later. There is a chart of formula here. I will come to this chart later. Is it okay? Yes, because I want to complete my chapter and go away to my home. So I will first complete off my chapter and then we'll see. Okay, this is about your income statements and that is how it will go. I want each one of you to take your books, take a fresh page and write down. Do anybody know a concept called marginal costing? You know a concept called marginal costing? Then it should be easier for you. Okay. Again, don't mind if I ask you one more question. Do you know the concept of absorption costing? No problem. It is not there in my curriculum. I'm not going to teach you. I just asked for my knowledge. Okay. So please write down, sir. I'm going to name it what I thought I will name it. I will name it income statement only. make two columns. Revenue from operations, right? That means what is the total money which you are generating out of the business, that is called revenue from operations. In your layman's term, you can also call this as sales, turnover, whatever it is. Okay. Directly I will take it to the outer column, or let us do it this way, take it into the inner column. Now less, less what? Variable cost. Why? Can you have revenue without variable cost? Is it possible to have revenue without variable cost? Would you sign up if suppose there is no faculty? Understand. Very important for you to understand. Would you pay your fees if there is no faculty? Everybody in the class. There is computer, there is table, there is chair, there is projector, there is equipment, everything is there. But only thing is faculty is not there. Would you sign up for it? Important or not? Yes. Yes. So that's why what we call this as without variable cost operations are not possible. And actually once you do a business, you do not earn sales, you actually find out what? A number called, very good, a number called contribution. Number called contribution. Are we all good here? Done, guys? Right? Less. Only faculty is there. Okay, if it is cool, it is. Okay, I would say if only variable costs are there but not fixed cost, even then it is not possible. Yes, even then it is not possible, right? But there is one important thing to understand. There is a higher risk associated with fixed cost apart from a variable cost. In case if the things go south, that means in case if the things doesn't work, business collapses, right? You will be able to avoid variable cost but still have to incur fixed cost. So is there a higher risk involved? Yes or no? That's it. Yes. So because of this higher cost, right? Right? You will be able to find out a number that will be called, this is your earnings, but there are two more expenses which you have not subtracted. One is obviously finance cost, right? And obviously the government cost of doing business, right? We cannot minus interest, government taxes now, even though it is variable in most of the cases. Yes, is it variable? More the income, more the taxes, lower the income, lower the taxes. Is it variable in certain manner? But it is the last preference in terms of payment. In suppose you have to do any payments, what is the last payment which you do? Even after the interest payment, or you can say second last payment. Last payment is profits payment, but second last payment is taxes payment. Second last payment is taxes payment. Why second government payments are second last? That is one reason that interest is a tax deductible item. So you should first minus interest, and on the available amount only you are supposed to minus the interest. There is one more reason. You have to first pay out all your expenses. Only if something is available, then only entrepreneur would be paid. Obviously government is paid before the entrepreneur, but at least something should be left out for the government also. If suppose nothing is left out, then even that would go. Are we all good? Are we all good? So that's why government payments are always the second last. Last is profits payment, and the third last is interest payments. So now we call this as profit before interest and taxes. Again, in your glossary which you are maintaining at the last page, this is the first time I am using the whole definition. Sorry, I will not be using the whole definition ever now, at least in this batch, and I will use a term called EBIT. EBIT. Are we all good? Yes, sure. I'm not completing this statement right away. I actually want to mature you into the same concept. Just let us give one example. My sales is suppose say 1 lakh, right? Variable cost is 60%. Okay. Then my fixed cost is 30,000. Can somebody tell me how much is my EBIT? Please calculate. 60% of sales, that is 60,000. I get a contribution of 40. Then I get a EBIT of 10,000. Right? Yes. So what was happening? This major rent was going for 30,000 was going for rental expenditure, right? I found out a better locality with a lower rent, and I was able to reduce my rent from 40,000 to 20,000. Possible? Yes. Please tell me what is my revised EBIT. Contribution will remain same. So my revised EBIT is 20,000. Correct? Are we all good? So can you tell me what has happened? Am I able to earn more only with a lower interest or lower expenditure? Yes or no? Yes. So can I manage my fixed cost? Possible, right? I might have 10 employees. Now I said COVID has started, I don't require employees, I fire them. So even most of the employee salary would be fixed, right? Until unless it is a service industry where you can make your employee salary variable, otherwise it is fixed only. So in that case also you can fire it off. You have one of a very recent example of better.com, which was in news for firing their employees over a Zoom call, right? So please tell me, my dear friends, what have you done by shifting to a new premises? Have you got a leveraged over previous position? Yes or no? Have you got a leverage over a previous position. Yes. What leverage you will name this? This leverage is because of what? This leverage is because of reduction in expenses for running the business. Operating, guys. Yes, is it because of what? So this difference is giving me an advantage because of. Are we all good? Right? Now, can we again turn to that page which we left and we said we'll do it later? Can you please come here? We are going to discuss only a limited manner of operating leverage. Right? If you see the operating leverage, he says the first word they have used is, it is degree. Degree means a ratio, right? It is not a number, it is a ratio. Degree of operating leverage. How do we calculate degree of operating leverage? Contribution by, the line is missing, so you can write down contribution divided by EBIT will give you something called as degree of operating leverage. With the example which we have here, suppose this is year 1, we were able to do this. Year 2, next year we were able to find a better premises, we were able to do this. Can somebody please tell me what is DOL in this one? What is DOL? Can you please calculate? I will say it's a contribution by EBIT. So what is my contribution, my dear friends? So can I say my degree is 4? Now, can you please recalculate even for the second year also? Yes. So this is for second year. Again the same. So what we'll have? Just 2. Right? What is the maximum leverage you can reach? Suppose COVID started. Year 3, COVID started. You are still at a 40,000 rupees contribution per se. Right? You are paying rent. COVID started. You already had collected student fees. You have already engaged a faculty. COVID started. Now, you cannot physically go to the premises. There was an option to go online. Student also agreed that we will learn online like this live classes. There was no rental expenditure at all. Yes or no? I was completely able to avoid rental expenditure. Yes or no? So my number went to 0. That is the most optimistic which I can go. I cannot make fixed cost 0 negative. Na? You cannot make landlord pay you rent. You have to pay, right? So it went to 0. So what is your EBIT? What is your EBIT? Can you improve your EBIT beyond this point? At least with the help of fixed cost, no, you have exhausted totally fixed cost. Yes, yes. Now, how much is your operating leverage? Now, a smarter guy can tell me, we always try to reduce or increase my leverage. Listen carefully. We always try to reduce or increase our leverage. Reduce, but the maximum reduction can happen only up to. Can you go below 1? Can you go below 1? Sure. Yes. Can you draw x-axis, y-axis, please? Right? No, you do not have to draw. I am drawing. Just see. Your job is to listen, understand. This is 0. This is, you can say EBIT, or you can say degree of operating leverage or whatever. So here 1 is there. X-axis, y-axis 1. Right? So this is a curve. So you will have 2, something like this. Right? So is this curve will meet at this point. This is the least DOL curve can go. How many of you agree or not? Yes, this is the least curve will go, right? Can it go beyond this? Can it go beyond this? Can it hit the origin? Guys, I'm asking, can it hit the origin? No. So can I say DOL would be greater than 1? Max equal. Max theoretically only equal, practically I don't think so. If he goes COVID also, if goes online, he might have to incur at least internet connection expenses. So theoretically I'm saying 1, okay, but practically it is very difficult to reach to 1. Done. Are we all good? Second, can I say DOL will never be equal to 0 to 1? It will never come within the range of. Are we all good here? Guys, very important discussion. This is what they are going to ask in exam. Are we all good? So that is why now, madam, your question of why we are multiplying also will be clarified once we go to DFL also. Are we all good here? Done. Make a note. We'll go, DOL is not completed, we'll do it beyond, but at least this concept, make a note. You can have better drawing skills, so use your drawing skills. Done. Yes. Okay. Are we all good? Let us see one more way of calculating the operating leverage. This is one way. Let us see one more way. Okay. Done, guys. Okay. Come here. In the same chart only, he mentioned either the degree of operating leverage could be contribution by EBIT, or what is the second chart? Percentage change of EBIT divided by percentage change in sale or contribution. Possible in a case where you don't have a bifurcation of fixed and variable cost. Are we able to understand this point? Guys, are we able to understand this point? Yes. In a place where you don't have a bifurcation of yes, fixed and variable cost, will this formula would be of any use? If suppose you have a bifurcation of variable cost, fixed cost, you can easily implement the first formula. If suppose that bifurcation is not available, can you implement the second formula? Yes. In the second formula, you don't require individual numbers. You require numbers for 2 years or 2 periods or for 2 situations. Anything it could be, right? Yes or no? Please respond, right? Yes or no? Now, percentage change of EBIT is what, sir? Percentage change of EBIT is what? Now, from 10,000 it changed to 20,000. What is the percentage change of EBIT here? Almost 100%. 10,000 का प्रॉफिट 20,000 हो गया भाई, 100% चेंज हो गया. But what is the percentage change of contribution or sales? No change. How much? 0. So this is an impossible. In this question, can you implement the second formula? Why? Anything divided by 0 is infinity. Correct? So depending on the situation, you can use a formula. Understood? Yes or no? Depending on the situation, you can use whichever formula suits you. When we go to the problem sections, then you can see this application of second formula also. Done? Right? Can I complete my income statement now? Right? Yes. Come back. That's why initially only I told you, you have to leave a whole page blank for the income statement. We will keep on jumping, right? Yes, and do it. Next one, sir. What is the next item should am I supposed to minus? Before interest, before tax. Of that means I have to minus, I have to bring it after tax, after interest. Yes or no? Yes. What should I do? Less interest, less interest. Yes, earning before taxes. Let me name this as EBT. Obviously, then I will minus taxes, which will be generally a percentage. Whatever the tax is there, I will minus it off. I will arrive at a number which will be called as PAT or earnings after tax. Profit after tax or earning after tax. Anything is okay. Are we all good? Are we all good? Yes. Tell me, do we now have a sufficient data to work out financial leverage? Financial leverage is based on finance cost. So which is a finance cost here? Interest is a finance cost, right? So do we have the finance cost enough data for finance leverage? Yes. I will not now go back to the formula section. I will want you to yourself tell us that what is the formula for degree of financial leverage. Tell me what should be the formula for degree of financial leverage. Please think. Same example I am elaborating. Same example I am elaborating. Right? I am taking it over here now. Year 1, year 2, year 3. Same example I am taking. Everywhere I landed at an EBIT of 10,000, 20,000, 40,000. Let me take three scenarios now. Scenario 1. Yes. What is scenario 1? I have an interest, right? What do I have an interest which was suppose say 8,000, which I was further able to reduce it to 4,000, and which I was further able to reduce it to 0, right? Can you reduce your interest cost to 0? Very much yes, by deploying total capital by owner's money. Possible, right? Are we all good here? Possible, guys? Yes or no? I need answers. Yes. Okay, so now we got an EBT, or suppose say 2,000, 16,000 and 40,000. Suppose for an example, tax is there as a percentage, that is 10%. So 200 will go for tax, 1600 will go for tax, 4000 will go for tax here. So my EAT would be 1800, 14,400, 36,000. Done? Agreed? Yes. Are we able to make it so far? Now tell me, how do we calculate degree of financial leverage? Now you very well know how do you calculate the degree of operating leverage? Contribution by EBIT. Yes or no? Now why only contribution by EBIT? Why not sales by contribution? Very good. Sales and contribution, what is the difference? Variable cost. Variable cost is 99% as a percentage of sales. So the sales by contribution will always remain constant. Sales by contribution, even if you do, it will always remain, or contribution by sales, whatever, yes, you will do, it will always remain same, 40%, 40%, 40%, 40%, correct? 0.4, 0.4, 0.4, 0.4. Yes or no? Why? Because that ratio will never change. Sales will go to 2 lakhs. Variable cost will go to 1,20,000. Sales will go to 10 lakhs. Variable cost will go to 6 lakhs. Is the percentage changing? Is the degree changing? No. So, is there a risk involved there? At least from the angle of leverage? No. That was the introduction of leverage chapter. Finding out the leverage between risk factors. So where is the risk involved? In the fixed cost. Fixed costs are of two types: operating, finance. Operating is taken contribution by EBIT. Then where is finance? EBIT by EBT. We'll come to that. Suppose tax, there is tax is 0. Then what is degree of financial leverage? EBIT by, done? Yes or no? What should be the financial leverage? EBIT by, guys, are we all with us? Yes, yes, yes. Everybody understood the basic fundamental concept? Everybody understood the basic fundamental concept? What is the fundamental concept of leverage? Leverage measures the risk involved. Leverage measures the risk involved. Lower the risk, better. That means lower the leverage, better. That is what we learned in operating leverage. Same concepts will remain same for finance leverage also, right? Lower the interest you have, better na. Correct? Now, the only point agenda which you will ask me, sir, what about taxes? Should we take EBIT by EBT or should we take EBIT by EAT? Tell me by your own knowledge. If suppose we ignore taxes now, is there any other way to accommodate it? Yes, no. There is no other way. Is there any other way to accommodate it? Is there any other way to accommodate it? No. But because of tax, because of tax, there is an advantage. How many of you agree with me? See here, because there was a higher interest of 8,000, I was paying only 200 rupees of tax. Otherwise, I would have paid 1,000 rupees of tax. How many of you agree with me? If suppose the interest is zero here, if suppose the interest is zero here, my tax burden would increase to 1,000. How many of you agree with me? Yes or no? This will become zero. 10,000, 10,000, 10,000 over 10%, 1,000. So because of interest, how much lower tax I am paying? 800? Guys, yes or no? Yes, sure. So now what has happened? 10,000 minus 8,000, I am getting a 2,000 rupees profit, and then 200 I am minusing it off. I am getting a net profit of 1,800, but actually I am getting this 1,800. Of this 1,800, 800 is because of tax. 800 is because of tax. My real earning is only 1,000. 1,800 का प्रॉफिट आया ना. अगर सपोज ये नहीं होता तो 800 रुपए इसमें जो कम है, the 1,800 which we are having is the 800 is because of tax shield on this. 800 is because of tax shield which you enjoy because of interest. Are we able to understand? This is very important concept here. You should understand this concept very, very, very well. Yes, because interest is a tax deductible item generally all across the world. Tax will be collected after finding out the net number after paying of interest. Tax is not a finance cost. Tax is not a finance cost. Yes or no? Conceptually, tax is not a, but because of finance cost, you have a saving. Because of finance cost, you have a saving. Are we all good? Are we all good? Now, my question is, are we supposed to take into account this saving while calculating financial leverage? Are we supposed to take into account this savings of tax when we calculate financial leverage? Yes. Now come back to the formula. I have given you enough questions. Let's see. Yes. What does it say? If it is simple formula, as I told you, tax is not a, guys, tax is not a finance cost, right? So general formula should be for the financial leverage would be EBIT by EBT. Simple. EBIT by, again, if you are not able to find out a distinction between finance cost and other thing, so what does he say? You can directly have what? You can directly have what? EPS, change in EPS. EPS is earning per share, right? Or you can have change in EAT, that is earning after tax, divided by changes in EBIT. Are we all good? Are we all good? Done. Yes. Yes. Are we all good here? So as of now, I am doing only what? As of now, I am doing only what? Financial leverage. Yes. So what would be my degree of financial leverage here? Please tell me, sir. EBIT. EBT. Yes. For the year one, how much it is? For the year one, how much is this? 10,000. 10,000. There are obviously certain doubts you will have. सर टैक्स का क्यों नहीं लिया, कब लोगे, कैसे करोगे, मैं सब बताऊंगा, बट पहले बेसिक स्ट्रॉन्ग कर लो. 10,000 divided by how much? 2,000. Sure. So how much is my leverage here again? 5. Next year, is my EBIT increasing to 20? Yes. And I am able to even reduce my interest. So how much? Now next year what is happening? 40,000. Yes. Divided by what? 40,000. How much it is? 1. Same rule. Which rules? Can you reduce it beyond 1? Yes. No. Again same thing. DFL will be greater than or at least equal to 1, and DFL will not be equal to 0 to 1. Done. Are we all good here? Are we all good here? Done. Now let's take our madam's doubt, initial doubt, first doubt of the class. For the combined leverage, why you are not adding, why you are multiplying? I actually don't add, don't multiply. I just take a simple synopsis, right? Understand this very carefully. Please understand this. I have contribution as my major item where the calculation starts, and EBT is the last item where I meet out all my cost. Yes, taxes is share of profit, dividends are share of profit, everything is share of profit. But after I make out my EBT, I have my final number. Yes or no? I have my final number. So total leverage in the business can we calculate by finding out this thing, contribution by EBT? Yes. Can I expand this formula by saying contribution by EBIT into EBIT by EBT? The total. Now you have seen this chart. Now you have seen this chart earlier. Please see again. Let us do it this way. Earlier we were doing this and doing this. This we were calling it DOL. This we were calling as DFL. Right? Now we are taking total. Now we will call this as DCL. Right or not? So what is the top line? Contribution. What is the bottom line? EBT. Clearly we are able to find out this is part. So can I say my DCL is equal to DOL into DFL? Mathematically correct. I can cancel this EBIT, yes or no? So that's why degree of combined leverage is what? Contribution by EBIT into EBIT by EBT, that is contribution by EBT. Any doubts so far? I believe tax may something you will have a doubt, but we'll clear it off once we go to preference dividend. But as of now, is it clear with everybody? Any doubt so far? The first doubt also we have solved. Why combined leverage is multiplication, not addition? Because combined means not adding. Combined means total leverage of the business. So in the year 1, what would be the leverage? So DOL is how much? 4 to 1, and DFL is how much? 5 into 1.25 into 1. Again, how much? 20, 2.5 and 1. Again same rule applies. DCL would be greater than or maximum equal to 1, right? Which is next to impossible to happen. That means in a business, no fixed cost, no interest cost. 1 DCL means no fixed cost, no interest cost, right? Again, can you reduce it beyond 1, less than 1? Not possible, right? It cannot be in the range of 1 comma 0 comma 1, right, sir? Please make a note if you have not made it so far. Make a note. We'll continue. Now, have we completed our income statement? No. Are we? What is left out if we have not completed? There is one more finance cost. That means DFL is not yet over. There is one more finance cost. What it is? Which dividend? Equity or preference? There are 3 forms of capital: debt, preference, equity. Sir, is this the only 3 forms of capital? No. But for our curriculum, we are learning only 3 forms of capital: debt, preference, equity. Debt cost is interest. Accounted, matter closed. Right? Preference, are we supposed to account? Yes, no. Again, the question answer lies in distinction or discretionary power. Initially only I told you there are certain costs with discretionary power, certain costs without discretionary power. Interest cost, is it discretionary? No. You have to pay means you have to pay. Preference dividend might come with some discretionary power, some, but you have to pay. Are we all good here? You might have some discretion, right? That too limited only at the time when you buy. That time only you have to write down all the conditions. I will give you this much, I will give you that, oh, this is repayable after this many years. But you have to pay. Yes or no? Can you issue preference dividend 0%? It will come at some cost. That means preference dividend is also a fixed cost. Yes or no? Yes or no? Right? Fixed finance cost, because it is used for raising capital. Done? Yes, sure. Write down, sir. Less. That's why this pay another 4 or 5 lines are there still in the income statement, right? So next one, right now. Less. What you will find out now? Earnings very important. अभी भी कुछ बाकी है क्या देना? नहीं सर, सबको दे दिया जिसको जो देना था. अब ये जो पैसा बचा सिर्फ मेरा है, बिजनेस ओनर का है, right? So this is called earnings available to equity shareholder. Still, there were few things we'll write down below this income statement. Don't disturb this page. Again, come down to this part, right? I'm expanding my this same sequence. Can I expand the same sequence? Sure. If you permit me, I wish to erase this, because below this again, otherwise I have to rewrite the everything, right? So minus preference dividend. Let us take first example. Suppose I have a preference dividend of 1000 here. Can I reduce it down? Suppose I made it 500 and then 0. I'm taking all hypothetical numbers so that we are able to see each and every example, right? So how much do I get here? 800s, EAT of shareholder, EAT for equity, right? Here, how much here? 13,900, 6,000. Let us take the most easiest first. Which is the most easiest one? Year 3. Yes. Why? No interest. No preference dividend. No interest. No preference dividend. Right? You have EBIT of how much? 40,000. Correct. But because you don't have any interest, are you paying excess tax? Because you don't have any interest, are you paying excess tax? How much? How do you calculate tax shield, or how much would be your actual outflow of tax? How much tax your extras paying? 10%. If suppose you had total interest against 40,000, if suppose you had 40,000 interest, then how much tax you would have paid? Correct. Now, is it right to say that degree of financial leverage in year 3 is 1? I have a simple question to you. I need a simple answer. Don't look at numbers. Please apply your mind. Is it right to say for the year 3 degree of financial leverage is 1? Apply your mind. It requires lot of senses. I told you, if you join my journey, you have to apply your senses. Is it right to say that year 3 financial leverage is 1? Year 3 is that's 40,000 minus 4,000 minus nothing. Yes or no? Let us first discuss conceptually, then we'll come mathematically. Okay? Conceptually, what does it say? Finance cost measurement is a leverage of finance. Financial leverage is nothing but measurement of finance cost, right? Are we getting restless? No, you should not. You should have more interest now. That is what degree of financial leverage का definition क्या है? What is the degree of financial leverage definition? Measurement of fixed finance cost. In year 3, there is no fixed finance cost. Is there any fixed finance cost in the year 3? So automatically the leverage should be 1? No. Yes or no, my dear friends? Any conceptual problem? In a Christian marriage, they say, if you have any doubts about this marriage, say now. They will say, announce it to the whole audience in the church. The marriage happens. There would be so much of gathering like Indian marriages. The priest will say, if you have any doubts, say now or be quiet for the rest of your life. Yes or no? At least in movies you would have some seen some Christian marriage. I am asking you the same statement. There is no finance cost in year 3. Finance cost of interest is 0. Finance cost of preference dividend is 0. Conceptually, if there is no finance cost, the degree of financial leverage should also be neutral. That's why it should be 1. Conceptually, do you agree with me? Any doubts? Raise your hands now or keep your hands down for the rest of your life. Think. Finance, degree of financial leverage definition says it is the measurement of risk involved because of finance cost. Correct? There is no finance cost. Obviously, there is no risk involved. So you will say, sir, mathematically it is not coming to 1. Conceptually, we all agree. What you will tell me? Conceptually, we all agree. Agree in what? That it should be 1. Mathematically, it is not coming to 1, sir. 40,000 divided by 36,000 is not 1. What is financial leverage now? 40,000, that is contribution. Now you have to even account for preference dividend, right? So you should go ultimate down, that is EAT for equity. So contribution is 40,000. Ante kada. ఈ తర్వాత after that EAT for equity is what? 36,000. Am I making a wrong formula? No. Look at my income statement. That income statement also says the damn same thing. What does it say? Take here. If I have this, how much it will be? Total I have to take now. As a section I have to take it. Correct? Yes or no? So contribute, it should be EBIT by earning available for shareholder. Sorry guys, I was doing right but telling you wrong. So it should be what? Formula should be what? EBIT. Sorry, I was doing everything right but I was writing it wrong, or I was in my flow. Right? So how much it should be? EBIT by the normal only interest, EBIT by EBT. If there is a preference dividend also, EBIT by EAT for equity. Year 3, theoretically the DFL, that is degree of financial leverage, should be 1 because there is no interest cost, no preference cost. 0, 0. But mathematically it is not coming. Yes. Why it is not coming? Because of tax. Why it is not coming? वो 4,000 का difference कहाँ पे गया? The 4,000 difference is where? Tax? No. Neutralized tax. In military, if suppose they have to kill somebody, they use the word don't kill. They use the word neutralize. Right? So military movies, if you have seen, so they use the word neutralize. So same word I am using. Neutralize tax. Kill tax. How do you kill tax? Remove the shield. Remove what shield? Remove tax shield. Right? So how do you remove tax shield? You have to find out if suppose tax was not there, how much would have been EBIT? Or you can say if suppose tax was taken before interest, then how much it was? So we will modify the formula. The DFL, the revised formula would become, now let me show you the journey of DFL. So DFL earlier started with EBIT by EBT. EBIT by EBT. Now you said, sir, there is one more preference dividend, right? That is also finance cost. So you said, why don't you write minus interest and finance cost at the same time? You said, sir, I cannot do. Why you cannot do? Sir, government allows interest as tax deductible but not preference dividend. Preference dividend is not tax deductible but interest is tax deductible. That's why I cannot take both at once. Are you able to understand? You should tell me. I was expecting, honestly speaking, I had an expectation from you saying what? Arey sir, why don't you write preference and interest at one go? Year only, change the income statement format. I was expecting that somebody will tell me, ये इसको इधर ही ले जाओ ना, घुसा दो इसके अंदर ही, एक ही साथ माइनस कर दो. किसी ने पूछा ही नहीं तो मैंने बोला ही नहीं. ठीक है. Why I have not done that? Why I have not done that? Because preference dividend is not tax deductible. That's why I have to insert tax between, right? But now neutralize tax, kill tax. How would you neutralize tax? Modify the formula, the modified formula EBIT. Neutralize means minus 1 minus tax. Sir, how it will neutralize? We'll see. Divided by EBT will have to be taken the downwards. That was EAT for equity. Now recalculate. That is 40,000 EBIT into 1 minus tax is what? 0.1, 10% na? 10% na tax ka rate. Percentage is given no? Divided by EAT for is 36,000. ठीक है? Right? So what would be the answer? Very important, very important, very important. 36,000, 40,000 into 0.9. Sir, कैसे आया 36? 40,000 into 0.9 divided by 36,000. Right? Further, 36,000 divided by 36,000 is equal to 1. Mathematically proved, conceptually proved. Ante kada? No, whenever there is a tax, this exercise is to what? Neutralize tax. If suppose tax rate is 0, whether you do 1 minus tax or not, it will be the same. 1 minus 0 is always 1. So your EBIT will remain same EBIT. That's why you implement the formula. See, you by heart formulas, you will always have issues. You understand the origination of formula, you will never have an issue. Luckily, I have done origination of formula because I have never attended coaching. At least most of the subjects. Sir, I should also not attend coaching. I am teaching you with the origination, don't worry. Correct? Got it? Conceptually matched. Year 3. Only I am discussing year 3. Year 2 and 1, now you can do it. Simple. Year 2 and 1, you can do it now. Yes or no? Now, you also understand that by doing 1 minus tax, as if tax you have taken as a over and above item. Matter closed? Done? Make a note. Before you make a note, 1 second. Let me also show you this notes part so that I am free. See here, this percentage changes wale formulas I have not done it so far. Okay? But this one I have done. This one I have done. Have I also done this one? EBIT into 1 minus tax divided by EAT for done. Closed. Yes. Chalo. Write down. After this explanation, even though you do not have any finance background, you will be able to do this. That's why I have told you, even if you are not done accounting, you can understand. Right? Finance starts where? No offenses to accountants. CA means chartered accountant. Year 1 and 2. Yes, write down year 3, then I will show you year 1 and 2. Year 1 and 2 do as a homework now. Okay. Yes. Done. Can we do it year 1 and 2? That should be cakewalk for you, all of you. Year 1 and 2, please. Yes. I am just modifying the same calculations here. Right? I'm just modifying the same calculations here. Okay. Now what? How would be the calculation starting now? The formula is DFL, that is EBIT divided by into 1 minus tax. Done. Yes guys, are we all good here? So calculate for the first year. Year 3, I will just again rewrite the year 3. That would be 40,000 into 1 minus zero point 0.1 divided by 36,000. So that would be 1. Again redo it here. 40,000 into 1 minus point. Okay, so here EBIT is changed. So here EBIT is 20,000 divided by 13,900. So that would be 18,000 divided by 13,900. So how much? Wrong. 1 point. I'm just using up to 2 decimals. 1.29. The first year into how much? 11 point. First year I was very risky. My financial leverage was 11.25. That means, let us have some general discussion. That means, you can write it later, please understand. That means, out of the earning of 10,000, I was spending out only on the cost of raising capital 9,200. Very high risk. If suppose my EBIT goes 1,000 rupees, then I would be in losses. High, very high risk, right? That's why see the financial leverage is as high as 11.5%. Very high risk. But over a period of time, I've tried to improve it to 1.29 and then ultimately to 1. Are we all good here? Sure. Done. Come back to your income statement, guys. If you wish to make a note, make a note. Done. I don't think so this would take much of the time. Yes. Only this section you might have to make a note. Balance is already written because you cannot clean in your notebook, so you have to rewrite again and again. It is highest risk until you become insolvent. Vijay Mallya kept on taking risk and risk until unless his bubble burst. So people keep on. You have so many examples. The factors of taking high leverage is year 1 is higher interest cost. Yes, higher fixed cost. In the year 1, operating leverage and financial leverage both are very high. If you take a combined leverage, it is somewhere around more than 50. 4 into 11.55, it is somewhere around more than 40, 50. That's a pretty huge number. That means your one small hiccup, not you don't like a hiccup like COVID. one small Bharat Bandh will take away your business. That kind of a fragile is your business in year one. Samjhe? Got it? Yes. So that's how it is. Minus here, minus, less. We are going continuing our income statement. Less. Equity dividends. You have to pay equity dividends. There is no leverage on equity dividend. Why? Discretionary. Right? Yes. What you will be remaining with? Retained capital. Retained capital, or you can also say reinvested in business. Reinvested capital. This is the money which you reinvested into the business. If you divide EAT for equity, below the income statement only you are supposed to write this, divided by number of outstanding. OS is the short form of outstanding shares. You will get something called as earning per share. Yes. Right. Make a note. Should we start? Right. Sure. Right. And again, the last one is already given to you. The contribution in case of DCL also. If suppose there is a tax, contribution into 1 minus tax divided by EAT for equity. So that is already given to you. If you wish, you can compute for your numbers, or directly you can multiply DOFL into 3FL. Okay, sir. Now there are some small analysis for you. What does the analysis say? High fixed cost means high leverage. Needless to say, correct. High leverage means high risk, and high risk means higher change in profit. It could act any which ways. You might get more profit, you might get less profit, even for a small change in sale. If you are taking such a high risk, as you asked, in the year one, there is a financial leverage is as high as 11.25. So that means if the sales drop by 1000 rupees also, right, what would happen to the profit? It will become negative. So there is a high risk means high change in the profit even for a small high change in profit even for a small change in sales. Percentage change in sale or contribution is always same as only variable cost comes between the variables. Are we all good? Already mentioned. Percentage change in EBT, EAT for equity, EPS will remain same when only variable cost comes between these picture. That is, there is no preference dividend. Suppose there is no preference dividend, EBT will be equal to EAT and all that stuff. When there is a fixed dividend, then the percentage change in EAT and EAT for equity will be different. Simple. This is all conceptual. If you are able to understand the income statement, these are all very simple to understand. So that's why I told this chart and this chart, will take it later. Right? Done? Okay. Now there are few problems which I wish to start with. Please say we have I've already given problems to you. Let's start with the first problem, that is problem question 1A. This is from your study material. Let's see how many of you can do it before me. So problems set, sir. One second. This discussion also let me complete. This is a discussion of income statement. Already we have made it, so there is no discussion required. Sales minus variable cost, contribution minus fixed cost, EBIT minus interest, EBT minus tax, EAT minus preference dividend. It is EAT for equity. Correct. So here this difference, contribution in EBIT will lead to operating leverage. That is contribution by EBIT. Here EBIT by EBT leads to financial leverage, that is EBIT by EBT, right? If you take the overall and then do EBIT by EAT for equity is wrong. I myself have striked off. Can you see this? So that clear understanding I want to have. Why it is wrong? Because it is pre-tax, it is post-tax. Numerator is before tax, denominator is post-tax. That is why the difference was there. That is why first I conceptually tested you, right? Then what you should do, make everything post-tax or pre-tax. So what you did, you made numerator post-tax by doing 1 minus tax. When there is a preference share, so financial leverage into EBIT into 1 minus tax by EAT for equity, and that is how the formula has come. Done? Happy? No doubts? Taxation is also solved. Okay, let's come down. Do question 1A, study mat. A company produces and sells 10,000 shares. The selling price of the shirt is rupees 500 per shirt. Done? The variable cost is rupees 200 per shirt and operating cost is 25 lakh. Calculate the operating leverage, and if sales are up by 10%, then what is the impact on EBIT? So here in the second bit you can use the second formula, right? Can we solve this, guys? Do I have your support? Can I make what is the first thing which I have to do? I have to make an income statement. So mark it answer 1. Answer 1. So income statement, that is sales. How much would be the impact? Yes, the sales would be 10,000 into how much? 500. So how much is the cost, sir? Total 50 lakhs is the total sales volume less variable cost. So that would be how much? That variable cost per shirt is 200. So 10,000. So my EBIT comes to contribution comes to 30 lakhs. I have a fixed cost in terms of supervisor salary, rent and everything. 25 lakhs. Then you get EBIT of how much? 5 lakhs. Right? So what is my DOL? This is the only information we have. What is my DOL? That is contribution 30 lakhs divided by 5 lakhs. So my DOL is 6. So is this the first bit answer? You have got 1.5. This question will come for 3 marks. You have got 1.5 marks. 1 marks you might get it for this, and then 1 mark for this. Basically you might get 2 marks now, and 1 more mark you will get it for the second bit. So what is the second bit? So this is ICI ranking. I am telling you how do ICI give the marking scheme. ICI marking scheme: 1 mark for the making income statement, 1 mark for calculating the first bit answer, 1 mark for the second bit answer. What does the second bit says? If the sales are up by 10%, what is the impact on EBIT? So what you can do, simply do, here normal, here up by 10%. So how much it is? 55 lakhs. Done. Then minus what? Minus what? If sales goes up, whether variable cost will also go up. If sales goes up, whether variable cost will also go up. What does he say? If the sales are up by 10%, he is not saying selling price, he is saying sales. So instead of 10,000 shirts, now they are saying selling 11,000 shirts. Instead of selling 10,000 shirts, now they are selling 11,000 shirts. So what would be my variable cost also? 11,000 into 200. So even my variable cost will also go up by 10%. That is the basic concept which we have learned. So now this would be my 33 lakhs. Fixed cost will remain fixed. That is why we call it as fixed. So how much we have as new EBIT? Yes, how much you have as a new EBIT, sir? Tell me. How much it is? 8 lakhs. Can you please tell me how much is percentage change? 60% change. How? Change is how much? 8 lakhs. 8 lakhs minus 5 lakhs divided by again 5 lakhs. So that would be nothing but 3 lakhs divided by change by base. Sensitivity analysis, change by base. 60%. Are we all good? Are we all good? Sure. So change is 60%. Now I can use it by first formula also. Let me just solve it by second formula. What is the second formula of TOL? Percentage change in contribution, percentage change in EBIT by percentage change in sales or contribution, because their percentage will remain same. Here also you see 30 lakhs to 33 lakhs, so 10% only. So what should I do here? TOL revised is how much? 60% by, that is 6. I'm just verification of answer. Verification of answer. I am not trusting the formula, I want to verify it. So you do it by the first one. So what is the first one? He says 33 lakhs. That is contribution divided by ओ कहीं पे कुछ गलत कर दिया क्या? We already have answers written. Acha, he is not asking us to calculate the DOL. Sorry, he is asking us only to calculate EBIT. So what is this itself is my answer. So this is not an apt problem in order to solve it by both the methods. This is not an apt problem in order to solve it by both the methods. ठीक है, तो percentage change is 60%. You might get 1 mark here. EBIT change is simple, 60%. Are we all good? Done? Okay. So this will again give you 1 mark. This is not an apt problem to solve it by both the methods. Are we all good? Done? Sure. Sure. We'll end our class today. Okay, because the next problem we cannot complete in the given time. So next problem will take little extra time. Okay, thank you.